Hi all, welcome to this session. So in this today's session, we are going to cover long-term financial management. Long-term financial management is the process of creating long-term value in the organization. When it's come to short-term financial management, it is the process of conducting or running the financial operations smoothly. But when it's come to long-term financial management, it's a long-term process to create value and wealth in the organization. So in the world of finance, normally, in the short-term financial management or normal financial management is carry out the day-to-day financial management activities. But when it's come to long-term financial management, it master how you are creating value into your organization. When it's come to value creation, it should be little beyond the short-term financial management. So long-term financial management is essential art in balancing of two things, that is risk and return. Long-term financial management is the balancing of risk and return to create more wealth and value in the organization. So, when it's come to long-term financial management, it is mainly designed for the higher level or top level management. They are carrying out or they are responsible to create more value in the organization. When it's come to the short-term finance, when it's come to middle level or lower level financial management team, their core responsibility is to run or to show the day-to-day financial activities without any disruption in the process. So long-term financial management is the balancing of two things that we already discussed, that is risk and return. So here two things has to be balanced. The first one is risk and return. So how it is going to be balanced, the risk and return? How it is going to be balanced? The first thing, defining the exact capital structure. That could be the key part in the long-term financial management, that is designing a proper, appropriate capital structure. What is a capital structure? Capital structure is an ingredient or a mix of long-term funding. It includes some specific fund like debt, equity, another mix of this can be included. Long-term financial management or in the capital structuring is the process of defining the exact capital structure for the organization, whether it is debt, whether it is equity or mix of both. So how it is designing normally, it is based on various different factors like the expected risk and return and the business cycle. There are a lot of factors has to be considered while we are designing a capital structure for the organization. So in the capital structure, we can see that there are two ingredients are mainly. The first one is debt capital and the second one is equity capital. Debt capital is a contractual obligation. That means you borrow money, pay interest and use that fund to run the business. That is the debt financial. When it's come to equity, you don't borrow the money. Instead of you are issuing shares to shareholders. By using that fund, you can run the business and you can build your business. So this is two type of fund that is commonly available for the business. The first one is debt and the second category is the equity. So in both debt and equity have its own merits and demerits. When it comes to debt, the key advantage of debt capital is its low cost of capital. When it's compared to equity capital, the debt capital have only low limited capital or capital expense when it's compared to equity fund. So if you are looking into the debt fund, normally it is comparatively low risk compared to the equity capital. So normally the investors are expecting only lower level of return. Suppose 10% or something, a fixed percentage of return only normally investors are expecting when it's come to debt financing. But in the case of shareholders or equity capital, they are expecting more return because they are taking more risk. So obviously they are expecting more return as well. So one of the key difference between debt and equity is that means its cost of capital. That means debt comparatively is low cost when it's compared to equity capital. And also the other thing, debt has its own tax shield. So that means cost of debt is tax deductible. So you can save that tax by using debt capital in the business. But when it's come to equity capital don't have tax shield. So this protection or this tax saving, what we called is tax shield. So debt have tax shielding, but when it's come to equity, there is no tax shielding. So this factor also has to consider when it's come to designing a capital structure. Again, when it's come to risk. So now we discussed the return. So let's come to risk. Obviously, both have its own risk element. Debt means higher risk. Whether you are generating enough profit or not, definitely it will not consider the debt holders. Debt holders will expect, or we have to pay that amount to debt holders. Even if you are generate profit, or even if you are in the case of loss also, you have to pay the debt return. But when it comes to equity shareholders, they don't expect the return if the company is not generating enough return, or in the case company is gone to something wrong, or in the loss case, they are not expecting that return. But when it comes to debt, they are expecting that return, whether you will generate profit or not generate profit. So when it comes to return, when it comes to risk, debt normally considered as a more riskier capital element than equity, because it is first thing, it is pledged against the company's security, and second thing, the investors are expecting return, whether you will generate or you will not generate any revenue. Any of the cases, the investor are expecting a return in the capital or in the debt finance. But when it comes to equity, you can pay the investors based on your profit generation. So two things we discussed now. The first one is risk, and the second thing is return. Again, the risk, we compare debt, equity. Risk is higher in the debt, and risk is normally lower in the equity. And the return also, the cost of capital is lower in debt, and the cost of capital is higher in the equity. So this is the key difference between debt and equity. So when we are designing or combining or forming a capital structure, these factors has to be considered, and we have to select an optimal capital structure by considering all these things. Eventually, we cannot run the full business only with the equity and only with the debt if it is an optimal capital structure. So to be more optimal capital structure, the financial management has to find an optimal level of debt and equity that is suitable for the business requirement. So just look into this picture is just telling you what is the element of component of the capital structure, that is debt and equity. And again, it is explaining what are the features with related to debt and equity. So the final note is, when we are designing a capital structure, these things has to be considered, and the management has to find an optimal capital structure that is very relevant, that is very suitable for the business requirement. So let's move into next discussion, that is the source of fund, that is internal and external source of fund. So once we design the capital structure, the second stage is to source the fund, or to find that capital or find that fund. So definitely any company have two types of source of fund. The first one is internal, and the second one is external fund. Internal fund means that is fund available within the business that can be useful for further expansion or business development. The second thing is the external fund, that has to raise from external parties, whether in the form of debt or equity, that to use in the business expansion or business development. So in the internal fund, the key fund is the retained earnings. Retained earnings, that means the accumulated profit from the previous and current period. That's what we call the retained earnings. So that retained earnings belongs to capital or owner's equity. So that fund can be used as an internal source of fund in the business. When it's come to external fund, definitely the debt funds are there, and the equity fund. These are the two commonly used external fund. The debt fund means the using external debt or to taking long-term bank loan, that is the external fund, that is debt market. When it's come to equity, There are two types of stock you can issue, that is equity stock or preferred stock based on your capital structure preferences. So these are the two types of fund that is available for to raise the fund for a business. The first one is internal. Internal fund means the fund already available within the business. It is mainly the retained earnings. And the external fund, that is the raising fund from the external market. Maybe it's debt market or equity market. So let's come to next discussion, that is how we find a perfect mix. So we already discussed that there are two category of fund, that is internal and external, and again the debt and equity. So there are two types of fund or the capital structures are there. So the question is how to find a optimal capital structure. This is the another question the management has to find the to reduce the answer. The criteria we already discussed. The first thing, the risk has to be minimized and the return or the cost of capital has to be minimized. So this thing has to be considered. So where we have to find an optimum level of debt and equity to where we have minimal or lowest weighted average cost of capital with a expected level of risk. So we have to consider the cost of capital and expected level of risk. If we increase the debt very well or very more, then definitely your risk will increase. If you reduce the debt, definitely your cost of capital will increase. So these two things has to be the weighted average cost of capital and your ability to take the risk. Both factor has to be considered to formulate a optimal capital structure. Again, the factors has to consider while deciding a capital structure. The first one is tax shield. Definitely that the debt is tax deductible. So effectively, we have to consider how much will be the effective tax deduction and the final cost of debt while we are designing an optimal capital structure. Then the financial distress. Definitely, if we already have too much debt, then it is very difficult to find another debt with a minimal cost of capital. So if we already have a more debt, definitely the financial institution will demand more return for their investments. So these factors has to be considered. What is the current level of debt and current level of equity in the capital structure has to be reviewed before deciding the optimal capital structure. Then the business risk. Obviously, if you are into a higher risk business portfolio or in a segment which have a very higher volatility or risk, so definitely you should focus more on the equity capital because you have a very higher level of risk and a volatile business condition. So if you take more debt, there will be definitely it will be a higher risk because if you didn't generate enough revenue and profit in the coming period, you will be into trouble if you are focusing more into debt capital. But you are into equity. If you are generating more profit, you can distribute that profit to equity shareholders. Even if you are not generating that profit, you can hold the return also to the equity shareholders. So these are the some factors you should consider while we are deciding an optimal capital structure. The tax shield, financial distress, and the business risks. These factors has to be considered. These factors has to be reviewed and analyzed before creating an optimal capital structure. So we'll move to next discussion, that is the bond. Bond, as we know, is a borrowed fund. If the company want to borrow large amount of money for 10 or 20 years, they normally issue the bond. They will not go for the bank loan, so they will not normally issue the bond. So no, and bond normally have a par value. Par value is what it is. Face value is the amount company promised to pay back at the very end. If the bond issued for a 10 years, the par value is the value that the company is promising to pay back once they issued once at the end of the period. The coupon rate is simply is the interest rate or rate of return that normally investors are expecting to get. Again, when it comes to company case, this coupon rate and their cost of capital can be vary because there will be a tax shield element while we are calculating the cost of capital in the corporate. But As an investor, the coupon rate will be his rate of return that he can expect from a bond. So why the companies are using more debt or debt fund into their capital structure? The example, the answer is financial leverage. To get that financial leverage, what is financial leverage? Financial leverage is use of more debt fund into the capital to leverage the more multiply the to magnify the rate of return or rate of return to equity shareholders. So let's look into two cases to explain how financial leverage working. Imagine two companies, a firm A and firm B both have $1 million in asset. Firm A 100% equity, there is no debt fund in the firm A, and firm B 50% equity and 50% debt with the 10% interest rate. Just assume if the both firm earn 200,000 in profit before interest and tax, that is EBIT, then let's come to firm A situation. So its rate of return is 20%. How they calculate 20%? Their total return is 200,000 divided by their total capital. It is full of equity, that is 20% return they can provide to equity shareholders. When it's come to firm B, there is a 50,000 interest. That means they financed half of the asset with a long-term debt. So there is a 50% interest for that debt. So their EBIT will be, EBT will be 200 minus 50,000. That is the interest paid. That means 150,000. So 150 divided by 500,000. That is 30,000. In the same case, the firm B can pay its owners 30% return, while with the same EBIT, the company A can pay only 20% return to its equity shareholders. So this is how normally the financial leverage works, and it's magnify its rate of return to equity shareholders. So you can see the same example here. A firm with no debt, so there is no interest. So its return on equity is 20%. So there is no full of its asset is financed by the equity capital. So its rate of return is equity rate return is 20%. But when it's come to firm B, half of its asset is financed by the debt. So the debt cost will cover with 50,000, and the balance 150,000 can be distributed, can be available to equity shareholders. So their rate of return on equity is 30%. So this is a classical example how the financial leverage works and how it is magnifying EBIT or the equity shareholders return by effectively using the debt fund in the business. So this is about today's discussion. So let's summarize today's discussion. So again, the purpose of capital structure valuation or creation is to create long-term value in the business by considering the both return and risk. Again, the optimal capital structure is a point where debt equity results with the lowest weighted average cost of capital. A point where debt and equity meet with the lowest weighted of average cost of capital and affordable rate of risk. Again, debt trade-off means debt comparatively considered as a cheaper cost of capital because it is comparatively expecting lower return. And the second element is it is tax deductible. There is a tax shield that is applicable for the debt capital. So it is considered as a cheaper cost element or capital element when it's compared to equity. Again, the same case when it's come to equity is comparatively it is considered as expensive compared to debt because the investors are willing or they are expecting more return from the equity investment because they are taking more risk. So there are two types of fund. Again, we discussed. First one is the internal fund, that mainly the retained earnings that is available in the business. Now the external fund, that is the external fund is the fund can raised through the debt and equity. Then the use of financial leverage. we discussed already how the financial leverage magnifying the effect of return on equity. So these are the today discussion. If you have any doubt or you need any clarification on any of this topic, please ask me on the comment section. Thank you for watching this video.